In this video, we will talk about Tilray, its merger, the stock movement, the circumstances around, and if you should buy its shares. Recently, Tilray's stock price went from around $8 on December 31st, 2020 to $32 on February 19th, 2021. This price increase is significant for two reasons. The first one is because it is impressive in percentage per se, since it almost rose by 300% in a little bit over 2 months. The second reason is due to the fact that it managed to increase that much despite being in a sector that deflated by a significant margin since its peak back in 2018 and 2019. When we look at the company itself, there are a few elements that should trigger our attention. The first one is that despite much hype from investors back in 2018 era about how profitable those companies can be, Tilray has yet to generate a profit. It has been incurring a net loss over the years and is not because it was doing research and development. Those losses result from a combination of assets value write-downs and heavy admin and marketing costs. The reason why those aspects matter is because the asset write-downs may say a lot about the company itself as well as the perception of value investors initially put in startups like Tilray. Keep in mind that for most startups operating in hot sectors, a significant portion of the value of the stock is in the valuation investors give to the future growth potential, which can be seen in the massive valuations that seem to be justified. We have seen this kind of phenomenon in EV sector as well, or with the big data company Palantir. Most of those companies have little value in the hard assets, but have a massive value reserve in the goodwill financial markets are willing to attribute to them. In the case of Tilray, the write-down for Q3 of 2020 results from shutting down a factory and causing the value from an ongoing basis to ready-to-sell basis, which are two very different valuations, may suggest that either the sector is rapidly evolving, causing the company to shut down a factory because the products are no longer needed, or that there have been strategic mistakes made by the management. Another aspect that is interesting is the heavy admin and marketing cost. In the Canadian market where Tilray operates, it is mostly selling to agencies owned by provincial governments. As we know, marketing to businesses is different from marketing to end users. It is much more straightforward and to the point. They need to market with numbers and statistics, in other words, price, instead of images and exclamation marks. If they need to spend significant amounts of money in marketing, it suggests that perhaps there are too many suppliers to compete for the demand that is available. In other words, there may have been an error of appreciation in the actual size of the demand, or rather the demand that governments are willing to offer to the end users. With that being said, there are also other kinds of products that can be manufactured, and that they may not all fall under the same level of regulations from the government. However, unless there are significant shifts in the consumer behavior, those products will be sideshows. When we look at the institutional investors who back up the shares, in both the number of investors, shares held, and percentage owned, the numbers are on the rise. It is really interesting to see that most institutions entered into the company in Q4 of 2019, when the share price has been largely deflated from the peak of $190 back in the beginning of 2019. Another noticeable element is the exposure most of those institutions are willing to risk in Tilray, and by extension, the sector itself. the vast majority of them risked below 1% of their portfolio. This means that despite the potential and the hype, the sector is considered to be very volatile and may collapse. The fact that they massively bought in at the end of 2019 when the share price is at a much lower position suggests that they believed that the sector was in a massive bubble, and that if they were ever to participate in the market at all, they would have to see some sort of massive corrections before doing so. This should be a lesson for us all who are in the middle of this current EV craze. In a world economy that has realistically entered in a period of recession, it is one thing to be optimistic. Entering at the right timing is another. The current catalyst for Tilray is the merger with Tlry, another Canadian company operating in the same region. This is good news because both companies can potentially reduce their fixed costs and increase the chance of generating a net profit. Before we move on to my recommendations, if you like my content, please like, comment, subscribe, and check out my channel for more analysis videos. My recommendation is to hold a modest position on Tilray. Despite the fact that the sector is no longer what it was, and that the high valuations investors initially attributed to startups have been largely deflated, the current price level is acceptable to enter, since the price movement suggests that the shares are in an upward dynamic and still has some room to go higher. Another factor would be the potential ahead. Despite the fact that the market is getting crowded, the merger can improve the competitiveness of the combined entity of Tilray and Tlry. All that in a newly available sector that is now entering into a phase of consolidation. Essentially, for those who believe in the sector itself and the potentials that it represents, now may be a good time to buy the shares of Tilray. Due to the volatility of the market, the maximum exposure I recommend is within 1% of your portfolio. Thank you very much for watching. If you like my content, please like, comment, and subscribe to my channel.